As they say, timing is everything. And just a few weeks back here on the Rare Advisor, I had revisited an old topic titled, Where Did All That Money Go? And we discussed the importance of taking a risk-managed approach when investing. Now, if you're familiar with USA Financial Formulas, you know that we are all about risk management and staying on top of cutting-edge, important tools to help you manage risk. Now, especially in today's volatile markets, this is more important than ever. So in this special episode of The Rare Advisor, I'm joined by Tom Haines, my good friend who was instrumental in the development of our latest research partner strategy. Now, I don't want to steal Tom's thunder, but he's got himself an impressive track record working with a variety of financial institutions with a specialty in smart beta index development. Now, this new PRISM strategy represents the first ever index developed by Standard & Poor's as the engine driving an SMA strategy. Needless to say, it's been a great relationship between USA Financial, Standard & Poor's, along with Tom and his team at Annexus. This interview is just going to scratch the surface. So to learn more, reach out directly to us here at USA Financial or check out the recorded webinar link that is shared inside of the notes below here on this video. Now let's get started.
This is The Rare Advisor, proud to be a part of the Advisor Advancement Network and home of a business model supercharged by recurring and repeatable events. Your host is Mike Walters, CEO of USA Financial. He is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor.
Well, hey, Tom, welcome. We're going to jump right into things here. We always try to keep these moving along very quickly. So right out of the gate, if you could just kind of describe for us the connection that you've helped to create between Annexus, Standard & Poor's, and now USA Financial.
Well, Mike, thank you so much for allowing me to be on your podcast today. And we really, from an Annexus perspective, value the partnership with USA Financial. You know, it's been a partnership that's lasted over a decade, and we really valued when you came to us last year, as you are, utilizing the index annuities that we build, and truly appreciate the smart beta index diligence that we do on our 18 indices. A lot of our smart beta indices in the market, the indices you see overall in the market, they're not diligenced. They're built on maximizing illustrations for the last 10 years in the index annuity market, when we really should be thinking like a fiduciary, how things are going to work for the next 10 years. And over the years at Annexus, we've had the fortune of bringing in our partners in indexing, like Jeremy Siegel, the Wharton School, Roger Ibbotson, who was my personal mentor, and Robert Schiller of Yale. And we've had that type of academic pedigree in the design of our index. Ultimately, it creates more realistic expectations when strategies are built on that type of research. And we appreciate USA's value that so for the years that you've been working with us. So in terms of the smart beta world, one indexer that was dear to me when you said, how could we bring the index diligence process from Annexus to the USA Formulas managed portfolio market, PRISM came up to me. And the S&P PRISM Index and PRISM framework is a framework that's very dear to my heart. Unlike going through an independent index diligence of Ibbotson, Schiller, Siegel, or a major asset manager, PRISM was a framework that I built. I built it upon the academic foundations of looking at market movement in different ways. Markets have fundamental movements, technical movements, volatility movements, and they impact the economy. Markets are based upon multiple assets. The thing, well, I'm just going to look at the S&P, or I'm just going to look at bonds. What about unexpected inflation? And how to bring in really a comprehensive asset allocation framework, a smarter way to deploy the U.S. marketplace using a rules-based method. And that's what we did in 2017 when I joined Annexus. So I'm speaking to you from my home office in New Jersey. I'm not actually based in our Scottsdale office. I'm boots on the ground with our index and bank partners in the New York City area. And when I built the PRISM framework, we took it to S&P. And we showed them that we saw a value of bringing this to the life and annuity market at the time, and they said it. They saw it. They did the diligence on Annexus and the PRISM framework, and they did a lot of due diligence, stress testing, and they saw the value and said, listen, we would like to license the framework license from you, Annexus, and we want to launch the PRISM framework as an S&P branded index. And that's been a tremendous relationship. So from the beginning of 2018, when we launched it, we actually first put a version in for the life market and with our partners at Securian. And from that point, the S&P PRISM Index has been the best performing index for the life and annuity market. Live performance, hands down. Even in the last year, 18 months, there's been numerous indices now that are getting about close to about 185, 190 smart beta indices. Well, many of those that have launched last year, when you look at the same track record from the February of 18 till now, PRISM has the best performance, which I think is astounding because we're not looking on the last 10 years. We didn't build the index on an illustration. We built it to navigate numerous markets. So when you came to me, I said, well, we can bring that into the managed marketplace, the managed model place. And the PRISM partnership with S&P is so special that when I went to S&P, they were ecstatic. They said, we would definitely want to do this. S&P is the largest index sponsor in the world, the oldest sponsor in the world with the Dow Jones Industrial Average that they now own. And they said, well, we've never built an index that will be the benchmark for the managed model market. We would love to do it. And that they embarked on us in the partnership, understanding your trading needs, understanding how we maintain the sanctity of the PRISM framework and make it implementable. You can have the best moral compass, you could have the best academic outlook on where markets are going, but if it's not implementable, what's the point? So when them bringing in our signals that rebalance, look at daily, well, that's still occurring, but now the rebalance is weekly, right? And we're using ETFs and expanding a partnership with BlackRock, where we're using underlyings, tracking iShares ETFs to do the same thing, navigating the U.S. asset marketplace with S&P 500, with corporate bonds, and appropriately commodities when we have unexpected inflation. And last, and not let's say least, especially in this environment, cash. The ability to, in this product, when the signals show concern, to go to cash in a tactical manner. Cash is king when you see 4.5%, 5% rates in the short term. So we were really pleased to see it. I think what's special about it as well is the ability to have a reference index. You know, not too long ago, we heard the stories of S Squared and other managed model providers, and to know that every night that S&P is independently tracking an index that your trading and portfolio managers have to replicate, I think it allows for the advisors to sleep at night, right? That there is a diligence process occurring in the managed model perspective, so that they at S&P is doing the diligence they can point to.
Right. So it's obviously you're excited about the opportunity as we are, and you touched on it there a bit, Tom. But there are multiple different components or multiple different opportunities in what the holdings might be based upon the tracking of the index. So if you could maybe touch on a little bit about the uniqueness of that and how you think that truly differentiates from what has previously been available in the marketplace.
Absolutely. It's multi-asset. We're not saying we're going into just equities or just bonds. It doesn't mean we're in all. I would say it arguably when we go through the performance analysis and risk analysis, it has superior returns over the bond market, almost near the equity market, but with the risk that mirrors the fixed income market. But what we're able to do is work within that U.S. sandbox. As I said, S&P 500, the corporate bond ETF, the LQD, as well as the Goldman Sachs, the GSCI Commodity Trust, and then cash, which is a T-bill ETF. And by bringing those together as our sandbox, we're dynamically allocating. We're not having fixed weights. This isn't strategic allocation. Well, I'm doing 60-40. This is dynamic allocation amongst numerous indicators. And I'll get into those indicators in a bit. But by bringing that together dynamically on a weekly basis, the weights will switch. They can be as low as 2 or 3% on equities or up to about 70 or 80%. On the bonds, the same type of thing. And commodities only come into play if they're really showing leading relative strength within the marketplace. So here we are today, the end of May 2023. The market is showing the index has about a 45% allocation to the S&P 500 ETF and about a 55% allocation to the corporate bond ETF. No commodities play, no cash. But that continues to evolve on an ongoing basis. which allows it to be dynamic. There's no leverage either. I think that's important as well. No leverage, an ability to be dynamic, no human set constraints, which I think allows for the best opportunity. So it's not data mined. It's not set in a way that worked in the last 10 years, but it's going to be able to navigate the market because markets change. Just even if return profiles change, correlations change, volatilities change, and allows us to do that.
I think just to jump in quickly, I think it's worth pointing out that not long ago here, when we saw bonds in a free fall, which was kind of in tandem with the market dropping at the time, bonds weren't the savior that many people had thought they would and could be, as they have been in the past. And it's interesting that the allocations were essentially sidestepping the bond market at that point in time.
Well, that's it. And that really brings me to the indicators. Well, what's under the hood? First of all, it's a transparent methodology. S&P is putting this methodology on the internet free of charge. So this is not black box. It's transparent. If you want to take the time out of your practice, read the methodology, get the data, get on Excel. I'm sure that won't make Mike happy.
And we'll have all the links available for everyone.
All links available. Yeah. But if you're really able to do that, you can, right? And we use the same proprietary process to do it, but we have it transparent. So what are those indicators? There's a technical aspect to the market. And what I mean by technical is adages from Charles Dow, like the trend is your friend. Being able to look at the last 1 year of return and seeing is the trend of that specific asset positively trending, or is it we're in a bear market, or relative strength? Tommy Dorsey, those who have followed Dorsey Wright and Associates, Tommy was a dear mentor to me early on in my career. And he really taught me about that idea of the relative strength, the arm wrestle. And the thought is the ability to look at asset classes. Are they winning that arm wrestle, or are they losing? That's important. But there's another side to markets that's fundamental. And I think you just hit it on it, Mike. We had a 40-year bond bull market. And people that were in their 20s and 30s in Wall Street thought that was all we would be in, a low rate environment. But when you look at the data, you look at, you pull this Ibbitson's SBBI book or poster, you see rates can be really high, and they were. And you can have unexpected changes in rates, which we experienced. And PRISM was able to predict that, the PRISM ETF tracker strategy, not because it was actively managed, it took common sense. The strategy says, whenever the 10-year treasury yield goes below 2%, there's probably not much left in the bond market. Pull back. If the credit spreads, if there's not much left in a credit spread, and what I mean by that, I'm going a little deep, but when you look at the yield on the treasury yield, the US treasury yield, and then you look at the yield on the corporate bonds, and there's a credit risk, if that gets too tight, why take that risk on? You're not being paid and rewarded for that risk. So we put those signals in there. It was pulling away from the bond market before the technical signals came in. And then the technical signals came in, to your point, Mike, right? It starts showing the worst bond market in U.S. history, right? Then the equity market had the worst equity market since 2008. So it started pulling back like that last year. And then commodities and momentum, when commodities are prudently managed. And what we think about that in the index is having positive relative strength, the best relative strength, and a positive trend, it should go in there. And in periods of unexpected inflation, it's important when when we're cognizant of the volatility of the overall portfolio. The other part which is unique about PRISM is, yes, valuation. We have valuation in the equity markets as well. When we're thinking about .com bubbles, is the adage of Alan Greenspan, the idea that the Fed funds model, irrational exuberance. He modeled that term irrational exuberance on this concept of looking at the 10-year treasury to the earnings price ratio of the S&P 500. And if that gets out of whack, and there's a better opportunity in the 10-year treasury than the S&P, let's pull out of the equities. And that's what we do there. And then recessions. USA Financial, I think, really credits yourself as being an advisor, understanding Wall Street, but operating on Main Street. And that's one of the things that really your advisors really value about you, that integrity. Well, recessions, I think anyone can understand recessions. You don't have to have a PhD to understand recessions can hurt the markets. Well, no one was putting that in the strategies. And Cam Harvey of Duke University, when he was at doing his dissertation in Chicago, said when the yield curve inverts, when the Treasury bills have a higher yield than the 10-year yield, that's a problem. That's probably showing a sign of a recession forecast, and that probably leads to a bear market. And his work is right. It's predicted 11 of the last 12 recessions. We put that into the strategy as well to pull away from equities, to be proactive. So I went really in the weeds of all those signals. The last part is volatility. If you're dealing with a portfolio approach, you got to have to also understand the volatility so that we're not going 100% into commodities in an irrational manner, or 100% equities in an irrational manner, that we're understanding all these indicators and then managing the process, understanding the whole volatility profile of the strategy.
So Tom, given that detail that you've just shared, to kind of back it out for just a second, where would you say, or where do you suggest that this particular PRISM strategy fits inside of an individual's portfolio or financial plan?
No, that's a really good question, Mike. And to help us answer that question, we actually did a diligence going back since 1973. It's actually I wrote it up, the study, and our compliance departments have reviewed it, and it's actually a white paper that USA has to really show that profile. So this isn't me just talking. You can see the analytics going that far back. So it has an equity-like return, but from a risk perspective, it's substantially lower. It has drawdowns that are actually lower than the bond market. It's going to have a little more volatility. So where does that fit? I would say that really can fit into your fixed income allocation, arguably. I think if you look at alternatives differently, you could make that argument. But a lot of times, strategic portfolio managers say, I'll do 10% alternatives. You're doing your portfolio a disservice. And in the white paper, what we found is in that study, you actually were able to show how we could look at different volatility profiles of risk and where it fits in the portfolio. So, that it's going to ultimately be between the advisor and the investor to make that decision, but we really think it can fit into those type of alternative sleeves. I don't want to come out and say it is an equity replacement, but it has kept up with the performance also because it handles the drawdown substantially better.
Right. And again, folks, we will have the links to some of the resources and so on will be provided to you below, and we can get that in your hands very easily as well. And so Tom, with the last few moments we have with our friends here, if you were going to just highlight the key points, the takeaways to kind of be a memory jog for people who are on here today, how would you best describe that?
It's a smarter way to navigate the U.S. marketplace and in a dynamic way that's going to allow you to have a strategy working hopefully on a go-forward basis as opposed to a historical basis that really is meant to be a true alternative for a portfolio. That's what we say based on the integrity of an academic diligence developed strategy and backed and verified by the leading index sponsor in the world, S&P.
Awesome. That's great. Tom, thank you so much for your time today. Thanks for the partnership. And everyone, again, we will have the links available to you. If you have any questions, obviously, you can always reach out to USA Financial.
Thank you so much, Mike. I really appreciate it. Have a good day.
Thank you.
This information is for licensed financial professionals only and is not intended for use in soliciting sales from the public. The views expressed represent the opinions of the presenter or their featured guest, not necessarily those of USA Financial or its affiliated subsidiaries. Industry references are generic and not intended to represent actions or beliefs of any individual or entity. Content is only presented to illustrate general principles, beliefs, or ideas and should not be construed as legal or regulatory advice. Trademark and copyright protected. USA Financial and Affiliates.